It was a bloodbath on Friday, specifically tech getting hit pretty hard. But I want to put attention into gold and silver because those got hit the hardest. And it's not really what you think, but look at this 30%, over 30% down side. And then immediately recovered a little bit and then saw a little bit of weakness in the after hours. So why did this happen? If you search up why did silver crash, the mainstream media is going to tell you it was Kevin Warsh. President Trump appointed Kevin Warsh as new Federal Reserve chair, which sent the dollar soaring, made it more expensive for foreign buyers, reducing demand. Additionally, the gold market's declined. Profit booking by investor at pilot metal also contribute to crash. So this is not entirely the true story or the full story. Sorry, this is just a distraction. The real reason why gold and silver crashed is because of this. Look at this. Where is it? Right here. Right there. The CME Group, or the Chicago Mercantile Exchange, raised margins on gold and silver and other commodities. Check this out. 5%. Oh, here it is. Gold futures 5% to 6%. Let me see. Silver should be around here. Silver. Okay, not this one. Silver should be. And then, okay, here it is. Gold. This one, they raised margins again after close on Friday. From gold from 6 to 8%. Silver from 11 to 15%. So actually, a couple days ago, this used to be from 9% to 11%. Now it's 11% to 15%. And it happened right after the crash, too. So is it a coincidence? No, this was engineered. It was planned. And what really happens when the CME Group margin hikes, what happens is you suddenly need more collateral to keep your position open, or you have to sell so you don't get margin called. You have to close your position because now you suddenly require more cash to keep the position open. So what happened there is that the banks sell, which triggers stop losses, which triggers margin calls, and then a cascade of selling happens, like what happened on Friday right here. And the craziest part is that, where is it? Here it is. JP Morgan closed 633 contracts short at the bottom of the crash. This is a smoking gun. You called exactly what the document proves. JP Morgan issued 633 contracts. That's 100% of all notice issued that day. They closed their shorts right at the bottom and they bought it back up. So retail got destroyed while banks were shorting. They made a lot of money while retail gets destroyed. And this happened back in 1980 during the Hunt Brothers era and in 2011. And it's happening again right now. So since the CME Group raised margins again for February 2nd, I just want to warn you that you should be careful because I suspect more downside is coming. So the CME Group caught traders off guard. Now there's going to be scrambling to cover their positions and possibly sell on the way down. However, for the longer term, I do believe that gold and silver will recover and make all-time highs again, because the fundamentals haven't changed. Like industrial demand is high, the supply is short, and I don't see this ending anytime soon. So the fundamentals are different from back then in 1980 and 2011. I wouldn't call this the end of the bull rally, but for Monday, if you hold any SLV, GLD, just keep in mind that we're going to see a little bit more downside. Now, personally, I would not own these two ETFs. I would just trade them to the upside or to the downside. What I would buy is mining stocks. Mining stocks like AG, maybe Newmont, Royal Gold, Barrick. So surprisingly, the mining stocks didn't get hit as hard as the metals themselves, but these are longer term plays, so just keep that in mind. Not financial advice. You do whatever you want. I'm just telling you what I think. But to end the video, I just want to mention crypto a little bit. Crypto's getting hammered. It's getting hit pretty hard right now, along with the market. So let's see. We'll see what happens on Monday. Be on your toes. Adapt. Just be careful, right? Okay, that's it for me. I'll see you in the next video.